A very beautiful couple I know, Jakes and Naomi, bought their first $150,000 Texas home, but ended up paying an overwhelming $265,000 in total after they completed their mortgage payment. Jessica took $98,000 in student loans, but ended up paying $162,000 in total after running the maths. Ben took a $5,000 credit card debt, but was able to clear it with $7,200. Now, what do Jakes, Naomi, Jessica, and Ben have in common? Welcome to Ivory Finance, a place where we show you the road when it gets tricky financially. Ever thought you scored a great deal on a loan, only to wonder, why am I paying so much more than I expected? Loans can be full of hidden costs and surprises. Today, we are tearing down the biggest sources of confusion, the difference between your loan interest rates and annual percentage rate, APR. Like most people, you've probably seen those two terms, but maybe thought, aren't they the same thing? Nope. And here's the kicker. Understanding this difference can save you hundreds or even thousands of dollars over the life of a loan. So, let's start with the basics. We've got two big players here, the interest rate and the APR, or annual percentage rate. To put this to perspective, let me use the pizza analogy. Imagine buying a pizza that costs $10. The $10 price is like the interest rate. It's the base price you pay. Now, if you want that pizza delivered, there might be additional costs for delivery, tip, and taxes. All of these added fees make the final cost higher than just the pizza price. This total amount you actually pay is like the APR, which includes the interest rate plus any additional costs that come with borrowing. The interest rate is only one side of the story. What lenders don't always highlight is that loans come with additional fees, origination fees, processing fees, and even service fees. All these little charges add up, and when you take those into account, you get the APR. So, the APR is like the total cost of borrowing. It's the interest rate plus those other fees, which means the APR gives you a much clearer picture of what you're going to pay over time. Studies from the Consumer Financial Protection Bureau, CFPB, show that nearly half of lenders, about 41%, don't fully understand their loan terms, which often leads to unexpected financial stress down the line. I mean, with all the fine print and complex calculations, who wouldn't feel a little lost? Before we go too far, I need you to also have it engraved in your mind that interest rates and APR apply to all lending products, from your mortgage, student loans, personal loans, auto loans, business loans, buy now, pay later to product payment plans, etc. Let's take a look at a real-world example. Imagine you're taking out a $10,000 loan. The lender is offering you a 5% interest rate, and that sounds pretty nice, right? But wait, when you check the fine print, you see that the APR is actually 7%. That extra 2%? It's the difference between just the interest rate and the actual APR. The interest rate is just where you're paying to borrow that money, but the APR includes all those extra fees, like origination fees, processing fees, and maybe even some other hidden costs the lender didn't highlight in bold. This might not seem like a big deal at first, but over a 5-year loan, that difference can add up to hundreds, even thousands of dollars more than you expected. And that's exactly why APR is so important. Now, here's where things can get a bit tricky. A lot of lenders will highlight a low interest rate in their advertising. You've probably seen these ads that say things like, rates as low as 3%, or borrow with rates starting at 2.5%. It could be a clickbait. That low rate often only applies to borrowers with nearly perfect credit scores. Another common tactic is to offer promotional rates that only apply for a short period. So, you might get that low rate for 6 months or a year, but after that, your rate can jump up. It's called a variable interest rate, and if you're not careful, it could end up costing you a lot more than you planned for. To be fair, not all lenders are out to trick you. Many are completely transparent about the interest rate and APR, laying out all the costs up front. These are the lenders who want you to make an informed choice. They know that a happy, well-informed customer is much more likely to come back. This transparency only works if we, as consumers, are willing to read through everything. I know the fine print is boring, and loan contracts can be full of financial jargon. But taking that extra time to read through terms, ask questions, and understand what each fee means can save you a lot of money and hassle down the road. At this point, you must be asking yourself, how do I command a competitive APR when borrowing? To secure a competitive APR, you must start by improving your credit score. A strong credit score, typically 700 or above, demonstrates reliability to lenders and often leads to lower APR offers. Regularly checking your credit report, disputing any errors, and paying down existing debt can all boost your score over time. Next, compare rates across multiple lenders before committing. Choosing a shorter loan term can also help secure a better APR. Lenders generally offer lower rates for shorter-term loans since they involve less risk. However, keep in mind that this approach typically results in higher monthly payments. Lastly, consider paying down existing debts and keeping credit utilization low, ideally under 30%. Lower debt levels make you a more attractive borrower, as lenders see you're capable of handling repayments responsibly. These are small efforts that can make a big difference in your loan costs. As we go further, I will reveal some uncommon tricks that will change how you view your borrowing power. I will start with the 0% APR credit cards. If you're a proud person like me with a very strong credit score, chances are you've received a credit card offer in the mail boasting a 0% APR, and consider applying. The thought of no interest for some time is enticing, particularly if you want to finance large purchases or debt payoff. But the terms vary by credit card, and you may not be aware of all the rules that apply to 0% APR offers. Before you jump on an offer and submit an application, it's important to know just how a 0% APR credit card works so you can use it to your advantage. A 0% APR credit card offers no interest for some time, typically 6 to 21 months. During the introductory no-interest period, you won't incur interest on new purchases, balance transfers, or both. It all depends on the card. These cards can help you consolidate credit card debt by transferring balances to a balance transfer credit card or paying for new purchases over time without incurring interest. But before you go for a 0% APR card, I bet you should be aware of the following. 1. The 0% APR period doesn't apply to all transactions. 2. The length of the interest-free period varies by type of transaction. 3. There are limits to how much of your balance qualifies for no interest. 4. There may be a fee for balance transfers. 5. You might not qualify for a 0% APR card. 6. Your offer may be canceled. 7. Any remaining balances will incur interest. 8. Some cards charge retroactive interest. In another video, based on popular demand, we will tear down everything you need to know about 0% APR credit cards. Some cards also come with a 0% APR introductory period on balance transfers, which allows you to transfer your outstanding balance from one credit card to another in order to get a break from accruing additional interest. This interest-free period typically lasts between 12 and 20 months. Another major benefit of a 0% APR credit card is the opportunity to earn rewards. There are many 0% APR credit cards on the market, so you can easily find one that saves you on interest and lets you earn a welcome bonus and cash back for your everyday spending. Lastly, it is possible to qualify for a 0% APR credit card with fair or average credit, but you might get a shorter introductory period. What do you do if you do not qualify for a 0% APR credit card? Buy now, pay later loan could be your next best option. Buying a pricey Peloton bike or spending hundreds of dollars on skincare at Sephora is easier than ever, thanks to the rise of buy now, pay later services, also known as point-of-sale loans. With buy now, pay later, you can spread out the cost of your purchases into installment payments paid over several months, occasionally with 0% interest rates, and have been most popular among young people. A 2021 LendingTree survey found that nearly 60% of Gen Z respondents surveyed had used a point-of-sale loan. This age cohort was also less likely to view using buy now, pay later as a form of debt. A buy now, pay later loan can be a good choice for you if you're unable to qualify for a 0% APR credit card, or if you're not looking to expand your credit beyond a single purchase, explains Matt Schultz, Chief Credit Analyst at LendingTree. Affirm, Afterpay, and Klarna are some of the most popular buy now, pay later providers. They offer financing options with 0% interest rates, typically over shorter repayment periods, which makes them a good choice if you can't get a 0% APR credit card. One of the most important factors to consider when getting a buy now, pay later loan is the interest rate and fees. A major benefit of using a buy now, pay later is that some providers don't look at your credit score at all or don't heavily weigh your credit score when determining your eligibility for a loan. If, however, you're looking to improve your credit score, buy now, pay later might not be your best option. Some buy now, pay later providers report your payment history to the credit bureaus while others do not. However, be warned that even if you're on time with payments on your buy now, pay later loans, they could still end up hurting your credit score if they're being reported to the credit bureaus. Here's why. Every time you get a buy now, pay later loan, you're opening a new line of credit and closing it whenever you pay it off. This could end up decreasing the average age of your credit history and therefore decrease your credit score. So, when is a 0% APR credit card better than a buy now, pay later loan? When deciding if you should get a 0% APR credit card or a buy now, pay later, you should consider a variety of factors. First off, you should consider if you have a good enough credit score to qualify for a 0% APR credit card. Additionally, do you need additional credit beyond a single purchase? Does your buy now, pay later loan have an interest rate? How much do you value the welcome bonuses and rewards offered by credit cards? These are questions you should ask yourself when deciding between the two, and if you make the right choice, you could end up financing your purchase without paying any extra interest or late fees. Now that I have armed you with the tricks for credit purchases, give me my flowers. One last thing. How do you avoid hidden costs when you are borrowing? It's all about reading the fine print and staying vigilant. First, check the interest rate and make sure you understand when it kicks in, especially if you have an introductory 0% APR. If that period ends, a high interest rate could start applying, so it's best to pay off the balance by then. Be mindful of fees. Late fees, annual fees, or balance transfer fees can sneak up on you. When considering a balance transfer, check if there's a transfer fee and whether the new interest rate applies to your entire balance or just a portion. If you're signing up for Buy Now, Pay Later plans, ensure you understand the repayment schedule. Missing payments might result in added fees or interest. Finally, watch out for any penalties for early repayment, especially with installment plans. By keeping an eye on these details, you can dodge those extra costs and keep more money in your pocket. Just to wrap it up, pay close attention to the type of interest rates and the possible financial product it applies to. Here's a breakdown of interest rate classes and the financial products that usually fall under each. 1. 0% interest installments. Commonly seen with phone and SIM plans, electronics such as laptops, tablets, TVs, and furniture, typically interest-free if paid in full within the promotional period, making it appealing for essential, higher-ticket items that require affordable monthly payments. 2. Deferred interest. Often associated with BNPL options, store credit cards, electronics, especially for major purchases, furniture financing, and medical expenses. Interest is deferred during the promotional period but will be back-charged if the balance isn't fully paid off by the end of the period. This is especially common with large retailers and certain healthcare providers. 3. Fixed APR. Used in auto loans, personal loans, business loans, student loans, and some mortgages. It's also common in credit card balances and extended BNPL plans beyond the introductory period. The interest rate remains constant, making monthly payments predictable. This is ideal for consumers who want consistent payment amounts over time. 4. Variable APR. Commonly used for adjustable rate mortgages, lines of credit like Helix, credit cards with variable APRs, and some private student loans. The rate can fluctuate based on market conditions, which can be favorable or unfavorable depending on the economic environment. 5. Prime rate-linked loans. Primarily seen with business loans, home equity lines of credit, Helix, and certain personal lines of credit. These loans adjust with the prime rate, affecting the interest and monthly payment when the prime rate changes. 6. Interest-only loans. Often found with certain mortgages and business loans. During an initial period, only interest is due, which keeps payments low. Afterward, the loan converts to include both interest and principal payments, often resulting in higher monthly payments. 7. Balloon loans. Typically used for real estate, mortgages, and sometimes auto loans or business loans. Borrowers make minimal payments initially, followed by a large balloon payment at the end of the term. This can be helpful for those expecting an income increase or intending to sell the asset before the balloon payment is due. 8. 0% promotional APR, introductory. Seen with credit card offers and BNPL promotional periods. No interest is charged during an initial promo period, making it an attractive option for those who can pay off the balance quickly. Understanding these categories helps you select financing options that match your financial situations and long-term plans. Remember, when it comes to consumer credit, knowledge is a massive leverage. Understand APR, read the fine print, ask the right questions, and you'll be in a much better position to make a smart financial decision. And who knows, you might even save a ton of money in the process. Thanks for watching. If you found this video helpful, don't forget to hit like, subscribe, and share with anyone who might be thinking about a loan. We'd love to hear your experiences with interest rates and APR. Drop a comment below, and let's keep this conversation going.